The Pentagon just set aside $125 billion for drones, and three stocks tied directly to it just fell nearly 40% this summer. I'm Alex Carter. Welcome back to Wealth Signal. Quick note before we dive in, this video is for education only, not financial advice. Always do your own research before you invest a single dollar. Drone stocks had one of the strongest runs of 2025, riding expectations of massive defense spending. Then this summer, almost the entire sector pulled back hard, some names down over 40%, even though nothing about the long-term story actually changed. Has been tracking exactly why this pullback happened, and it comes down to timing, not fundamentals. Today we're breaking down three drone stocks caught in that sell-off, and why the money behind them hasn't gone anywhere. If breakdowns like this help you cut through the noise, hit subscribe now. It genuinely helps this channel grow. First up, AeroVironment, ticker AVAV. This is about as close to a pure play on drone technology as you can get, with no other business lines diluting the story. The stock is up over 50% across the last 5 years, but the trailing 12 months tell a different story, down about 40%. This is already a profitable company, and its guidance for next fiscal year points to earnings holding roughly flat. That flat earnings guidance is exactly what's spooked investors who priced this as a pure growth story. But the stock is still trading well below where analysts see fair value, with institutional ownership above 85%. Big money hasn't walked away. AeroVironment has a new earnings report on the calendar, which means near-term volatility is likely either way. For a long-term investor, someone thinking in years, not weeks, a 40% pullback on a company still growing bookings is historically where patience gets rewarded. Before we move on, everything I've referenced visually in this video is saved as a downloadable summary file in our Wealth Signal Telegram channel, along with every past and future videos file. Links in the description. Go grab it. Second name, Kratos Defense and Security Solutions, ticker KTOS. This one's bigger, sitting around a $10 billion market cap, and it just gave the market proof instead of just a promise. Kratos was down about 23% year-to-date off its all-time high, and it's not a cheap stock either, trading around 120 times forward earnings. That's a lot of growth already priced in before the company had even proven it. Then the earnings report landed. Adjusted earnings per share came in at 21 cents, nearly double the 11 cents from a year earlier. Revenue hit $458.8 million, up from $351.5 million in the same quarter last year. The stock jumped roughly 25% in the following week. Even after that jump, Kratos is trading just below $60 a share, well off its January high of over $130. Analysts still see a consensus price target above $100, and the current forecast calls for roughly 70% earnings growth this year. Now imagine you're a smaller investor looking for asymmetric upside, not a blue-chip name. That's exactly the case for Redcat Holdings, ticker RCAT, a small-cap drone maker with a market cap just over $1 billion. Redcat is the only one of these three that isn't profitable yet, which means the company still relies on issuing new shares to fund growth. Real dilution risk for existing shareholders. That's the trade-off that comes with the smallest, cheapest name on this list. Redcat also reported earnings this week, and the underlying trend is encouraging. Earnings per share are projected to keep growing this year, moving the company closer to profitability. Revenue is on pace to beat the roughly $35 million it generated in 2025. This is high-risk territory. Short interest sits around 30%, and institutional ownership is only about 37%. But with just a handful of analysts covering it, and most of them bullish, this is the definition of an asymmetric small-cap bet inside a sector with real government money behind it. So, how do these three actually stack up? Starting with the riskiest. Redcat is the pure speculation play, smallest, cheapest, and still unprofitable, but with the most room to run if the government contracts start flowing its way. In the middle sits AeroVironment, already profitable, deeply institutional, but with a big earnings report still ahead and flat near-term guidance weighing on sentiment. This is a patience play, not a quick trade. And at the top, Kratos, the only one of the three that has already delivered the proof. Real earnings growth, a real revenue beat, and a real stock move to back it up, while still trading well off its own highs. So here's my take. 3 drone stocks sitting inside a $125 billion budget story, each at a different point in proving itself. If this helped, drop a comment telling me which of these 3 you'd trust most right now, and subscribe so you don't miss what we break down next. And if you want the visual summary file for this video, join the Wealth Signal Telegram channel. Link is in the description. I'm Alex Carter, and I'll see you in the next one.